By December 2026, the global property market will have undergone a structural transformation so profound that the very definition of an asset will have changed forever. While you are watching the evening news, waiting for interest rates to drop just one more quarter point, a silent tectonic shift is hollowing out the foundation of the middle class's greatest wealth builder. Most people believe we are in a temporary cycle. They believe that history will repeat itself and that buying the dip is a universal law of nature. They are wrong. In the next 16 minutes, I am going to show you why the exit strategy you've been banking on is already obsolete. If you are holding a flat, a starter home, or a speculative plot for a quick exit in the next 24 months, you aren't an investor anymore. You are a liquidity provider for the smartest money in the room. The year 2026 isn't just another date on the calendar. It is the moment the Great Reset of global housing hits the wall of reality. But here's the part nobody talks about. The crash isn't coming in the way you expect. It won't be a 2008-style fire sale. It will be something much quieter and much more dangerous. The Great Stagnation. Let's look at the method behind the madness. In the world of high finance, there is a concept called the illiquidity trap. Imagine you own a bar of gold worth $10,000. You can sell it in an hour. Now imagine you own a painting worth $10 million. But there are only 3 people on Earth who want to buy it, and they all just lost their jobs. Is the painting still worth $10 million? On paper, yes. In reality, it's just a very expensive piece of canvas. This is exactly what is happening to the property market. We have entered an era where market value and realizable value have divorced. For decades, the analytical method for real estate was simple. Population growth plus low interest rates equals guaranteed appreciation. It was a beautiful, linear machine. But that machine has broken. Now this changes everything. We are moving from an era of capital gains to an era of yield survival. If your property doesn't generate cash flow today, it is no longer an investment. It is a liability with a roof. How did we get here? To understand the rise, we have to look back at the ZIRP era, zero interest rate policy. For 15 years, the world was flooded with cheap money. This created a generation of accidental millionaires. People who bought a house in 2012 and saw its value triple by 2022. They think they are geniuses. In reality, they were just standing in the right place when the central banks opened the fire hose of liquidity. This led to the cold fusion of the housing market, the belief that property is a risk-free, high-return asset. But here is where it gets worse. That era was an anomaly. It was a fluke of history. The period from 2010 to 2024 was the cheapest debt has been in 5,000 years of human civilization. We are now returning to the mean. As we head toward 2026, the debt that fueled this rise is coming due. Trillions of dollars in mortgages are resetting. The people who bought at the peak are starting to realize that their equity was just a temporary gift from the government. But wait, there's a massive escalation coming that most analysts are ignoring. It's not just about interest rates, it's about demographics and the death of the starter home. The economic danger here is massive. For 60 years, the property ladder worked because there was always a younger, larger generation ready to buy the bottom rung. But look at the data. Birth rates are collapsing across the developed world. The buyer pool is shrinking at the exact moment the seller pool, the baby boomers, is reaching the age where they need to liquidate. This is the part where the math stops making sense. If you have 10 sellers for every one qualified buyer, the price doesn't just go down. The market ceases to function. We are entering the ghost era of real estate. This leads us to a deep truth that connects directly to your bank account. In a world of digital assets and instant liquidity, property has become the slowest form of money. Many of you are sitting on what you think is a fortune in home equity. But here is the market insight you need to survive. Equity isn't wealth until it's converted. If you try to sell in 2026, you will be competing with millions of others who all had the same genius idea at the same time. You will find that the banks aren't lending, the buyers aren't qualified, and your million-dollar home is a frozen asset. You see, everyone is wrong about selling in 2026 because they are looking at the price tag, not the transaction volume. A market with no transactions is a dead market, regardless of what the estimated value on your app says. This is why holding a flat for a quick exit is the most dangerous play in the current economy. You are betting on a future that has already been canceled. So what is the visionary future? Where does this leave us? The era of housing as a savings account is dead. In the future, property will be viewed as a service, a place to live or a place to produce income, not a speculative vehicle. The winners of 2026 won't be the ones who sold at the top. They will be the ones who recognized the shift early and moved their wealth into productive, liquid assets before the gates closed. We are standing at the edge of a new economic reality. The old rules said, buy land. They aren't making any more of it. The new rules say, buy cash flow, because they are making plenty of debt. As we move into this uncharted territory, remember this. The most expensive thing you can own is a sure thing that everyone else is trying to sell. The crowd is looking at the rearview mirror. I am telling you to look at the horizon. The market doesn't care about your plans. It doesn't care about your mortgage. It only cares about the math. And in 2026, the math is finally going to speak. Will you be listening? Choose wisely, because the bad you're holding might just be your own.